Trump's 10% credit card interest rate cap, what happens next? What if I told you that starting next year, credit card interest rates could be capped at just 10%? No more 22%. No more 25%. No more watching your balance barely move even after making monthly payments. That's the bold idea President Trump just put on the table, and it instantly set the internet on fire. On January 9th, President Trump posted that he is calling for a one-year cap on credit card interest rates beginning January 20th, 2026. At first glance, it sounds like a massive win for everyday Americans drowning in debt. After all, U.S. credit card debt has exploded to over $1.2 trillion, and nearly half of cardholders carry balances every single month. A 10% cap could save Americans an estimated $144 billion per year in interest alone. But here's the catch: calling for something is not the same as making it happen. Trump didn't say he will cap rates. He didn't sign anything. And history shows that similar proposals have failed before. So the real question isn't whether this sounds good, it's whether it's even possible. Is this a genuine attempt to help struggling families? Or just another headline-grabbing promise? And if it did happen, would it really help consumers or create new problems instead? Let's watch in 7 points. 1. The announcement, what Trump actually said. President Trump recently sparked massive attention after posting about credit card interest rates on January 9th. In his statement, he said he is calling for a one-year cap on credit card interest rates of 10% effective January 20th, 2026. His message focused on protecting Americans from what he described as predatory interest rates ranging from 20% to 30% or even higher. However, the wording here is critical. President Trump did not say he will cap interest rates. Instead, he said he is calling for a cap. That distinction matters more than most headlines admit. Calling for something is essentially a request, not a legally binding action. Anyone can call for a policy change, but that doesn't mean it automatically becomes law. This is where many people misunderstood the announcement. It sounded decisive, but legally, it was not a promise. It was a proposal, a signal, and possibly a political message, not an enacted policy. 2. Why this idea sounds so appealing to Americans. The proposal immediately gained traction because it targets a very real and painful problem: credit card debt. American credit card debt has reached a record high of $1.2 trillion, and roughly half of all credit card holders carry balances month to month, meaning they pay interest regularly. As of early 2026, the average credit card APR is around 22%, which is historically high. At those rates, even small balances can spiral out of control. According to estimates, capping interest rates at 10% could save Americans approximately $144 billion per year in interest payments. That $144 billion wouldn't disappear, it would stay in consumers' pockets. It could be used to pay down debt faster, cover everyday expenses, or increase discretionary spending. On the surface, this sounds like a huge financial win for working Americans. 3. Who actually loses the $144 billion? While consumers would benefit, someone else would take the hit, and that someone is banks. When you pay interest on a credit card, that money does not go to Visa or MasterCard. It goes directly to the issuing banks like JP Chase, Bank of America, Citi, and Capital One. Credit card interest is one of the most profitable segments of consumer banking. Slashing rates from 22% to 10% would dramatically reduce bank profits. That's why the financial industry is strongly opposed to this idea. Banks also have enormous political influence through lobbying and campaign contributions. So while the proposal sounds consumer-friendly, it directly challenges one of the most powerful industries in Washington. 4. Can Trump actually do this on his own? This is the most important legal question, and the answer is no. President Trump cannot legally cap credit card interest rates through an executive order. Interest rates on private lending are governed by federal and state laws, and changing them requires Congress to pass legislation. Even if Trump issued an executive order attempting to cap rates, banks would immediately challenge it in court, and it would almost certainly be overturned. That's why, as of now, no executive order has been issued. This is not new territory. Senator Bernie Sanders previously proposed a plan to cap credit card interest rates at 10% for 5 years, and Congresswoman Alexandria Ocasio-Cortez introduced a similar bill in March 2025. Both efforts failed to gain enough support in Congress. 5. Political support and why it's still just a concept. Trump has reportedly discussed the idea with certain lawmakers. Senator Roger Marshall publicly stated that he spoke with Trump and framed the effort as a way to reduce costs for American families and rein in greedy credit card companies. Still, it's important to understand where things stand right now. There is no bill, no vote, and no formal legislation moving through Congress. At this stage, it remains a concept, similar to other headline-grabbing ideas like stimulus checks or tariff dividends that never materialized. Some political observers believe Trump is using the proposal to rally voter support ahead of upcoming elections. Others think he may be laying the groundwork for future legislation. But until Congress acts, nothing changes. 6. How banks are responding in their real concerns. The banking industry responded almost immediately. The Bank Policy Institute issued a statement saying that while it shares the goal of affordable credit, a 10% interest rate cap would reduce credit availability and harm millions of Americans who rely on credit cards for everyday expenses. According to banks, such a cap would make lending less sustainable, particularly for higher-risk borrowers. While there may be some truth to those concerns, critics argue that the core issue is lost profit, not consumer protection. Credit cards are among the most profitable products banks offer, and a sharp reduction in interest revenue would directly impact their bottom line. It's no surprise the industry is pushing back. Another often overlooked consequence involves credit card rewards. Cashback, travel miles, and reward points are not paid by Visa or MasterCard, they're funded by issuing banks. If banks earn less from interest, those perks could be reduced, devalued, or eliminated altogether, changing how consumers benefit from credit cards. 7. The unintended consequences for consumers. Even if a 10% interest rate cap were passed, it wouldn't be an all-around win for consumers. Banks would almost certainly adjust their strategies to protect profits. One immediate consequence would be tighter access to credit, especially for borrowers with lower credit scores. Lenders could approve fewer applications, reduce credit limits, or close accounts they consider too risky. Another likely outcome would be higher fees. To make up for lost interest income, banks could raise annual fees, late payment penalties, balance transfer fees, and other charges that quietly increase the cost of borrowing. Finally, some high-risk borrowers could be shut out entirely. Customers who currently pay higher interest rates to offset default risk may no longer qualify for credit at all. From a bank's perspective, lending at 10% to riskier customers may simply not be profitable. In that case, the policy could reduce access to credit for the very people it's meant to help. Whether this proposal moves forward or fades away, the conversation around credit card interest is not going away. So the real takeaway is this: don't plan your finances around promises, watch the legislation. If anything meaningful develops, it will be written into law, not posted online. Until then, stay informed, stay cautious, and be prepared for whatever comes next. And don't forget to like, subscribe, and stay tuned for more captivating content on our YouTube channel.